Hello to all my fellow adventurers diving headfirst into this so-called get-rich-quick model. What I mean is, going from being broke to being completely wiped out overnight. Yes, that could very well be your reality. If you have no idea what crypto is, if you do not understand how this market works, if you have not watched this video, and if you are simply jumping in because you heard your friends made some money. Do not get me wrong, I am not here to bash crypto. I am actually a huge fan of it myself. But the risks in crypto are incredibly high. That is exactly why I want to make this video, to talk openly about the kinds of risks that almost everyone stepping into this market will eventually face. The whole point is just to help protect you, so if you are going to invest, you can do it in a smarter and safer way. Alright, let us break down these risks one by one. Risk number 1. Extreme price volatility and the illusion of smart investing. Back in 2017, when I first started investing in Bitcoin, the price at the beginning of the year was only around 800 United States dollars per coin. 1,000 United States dollars at the time, which was enough to buy a little more than one Bitcoin. Then I even asked my dad to borrow more money so I could buy more, because the price just kept going up. You could literally buy it one day and see a profit the next. Luckily, I didn't end up getting that loan. Looking back, I was definitely reckless. After that, the price just kept climbing. From $800 to 1,000, then 1,500, then 2,500. My money was growing fast. And I thought to myself, wow, making money is this easy? I must be a genius. The price kept rising. It hit $5,000, then $10,000, and by the end of the year, it was nearly $20,000. At that point, after several wins in a row and a few successful investments in ICO's initial coin offerings, I was holding around 5 Bitcoin. If I had sold at the peak, I could have walked away with nearly $100,000. That was a huge amount of money to me back then, but I did not sell. I believed the price would go even higher. Then the market turned around. The price started falling hard. At first, I thought it was just a small correction, but then it dropped more and deeper. When fear kicked in, I sold at a much lower price than the peak. Then the price bounced back. I regretted selling, and I bought in again. Then it dropped again. I panicked, and I sold again. And the worst part? Around that time, I saw an altcoin about to be listed on Binance. Back then, any coin getting listed on a major exchange like Binance usually surged in price. I believed in that, and I went all in, converting almost everything into that altcoin. Right after it got listed, the price shot up. But just minutes later, it crashed. The sell-off was brutal. Within a single day, I lost about 2 Bitcoin. At that point, I figured I had already lost too much, so I just stopped caring. I told myself, whatever, just leave it there, maybe someday it'll bounce back. But the truth is, there was no miracle. That altcoin slowly faded into oblivion. Its price dropped to nearly zero, and I couldn't even sell it anymore. Eventually, it disappeared from the exchange and I didn't even notice. In the end, I lost almost everything I had made that year. My perspective on Bitcoin and crypto in general at that time was just plain stupid. I thought Bitcoin's price was truly reflecting its real value. I believed that more and more people needed Bitcoin, and with limited supply, the price going up seemed obvious. I thought that once it rose, it would be hard to fall back down. Later on, I learned that the crypto market, at least up until now, has never really reflected true value the way most beginners think it does. Most price increases we see in crypto do not come from real value, they come from speculation, cash flow, and crowd psychology. The majority of people who buy crypto do not use it for anything specific. They buy it hoping that someday the price will go up so they can sell for a profit. Bitcoin is the same. Even though it was originally created to be an alternative currency, something to replace traditional money, it has never truly achieved that goal. Most people who hold Bitcoin do not use it for payments. They are just holding on, hoping the price will rise. And when a market runs mostly on price expectations rather than actual utility, huge volatility and big risks are unavoidable, especially for newcomers stepping into the game. Risk number 2. Futures, leverage, and the trap of faster profits. In crypto, risk is not only present when the market crashes. Even when the market is going up, or when the price moves just a tiny bit, you can either make a lot or lose everything if you trade futures and use leverage. First, let's understand what futures are. Futures is a form of trading where you do not buy real coins. You are basically betting on whether the price will go up or down in a short period of time. You only put up a small amount of money called a margin, but you can trade with much more than that. Leverage is what lets you do that. For example, if you have $100 and use 10x leverage, you are effectively placing a bet with $1,000, as if you actually had $1,000. If the price moves in your favor, your profit is calculated based on $1,000, so your money grows very fast. But if the price moves the other way, your losses are also based on that same $1,000, even though you only had $100 to begin with. Here is the problem. With leverage, you can only afford to be wrong by a tiny bit. The price does not need to crash. Even just a small move in the opposite direction can wipe out your margin and close your position. At that point, you lose all the money you put into that trade. If you had $100 and bet with $1,000, a 10% loss on that $1,000 means you are completely wiped out. And in crypto, these kinds of few percent swings happen all the time. Prices can move up and down violently within minutes, even when the overall market trend is still going up. And futures does not wait. The moment your position hits that stop level, it is closed automatically. The danger is, beginners often only look at the profits. They see that if they guess right, they can make money very fast. But they do not realize that with futures, the market doesn't even need to move against you, it just needs to shake a little, and you are out. A few years ago, I was also obsessed with futures. But over time, I realized it was no different from gambling. So I stopped chasing that dream. That is why futures and leverage are not tools for beginners. This is a very high-risk form of trading, and I want to stress that again, extremely high risk. A single small price movement can wipe you out. You should only trade futures when you really know what you are doing and are fully prepared to lose all of the money you put in. Risk number 3. Exchanges. Your money is not truly yours. One major risk in crypto that most beginners overlook is asset control. Many people think that once they deposit money on an exchange and buy some coins, those coins belong to them. So if they are not planning to sell right away, they just leave them there sometimes for years. But this is not safe. In reality, when your assets are on an exchange, you are not the one directly holding them, the exchange is holding them for you. If the exchange runs into problems, you are the first one at risk. Those problems could come from many sources: hacking, withdrawal freezes, bankruptcy, or legal troubles. And when those things happen, even if it is not your fault, you could still lose your money. These things have happened many times in crypto history. In 2014, Mt. Gox, then the largest Bitcoin exchange, collapsed after losing hundreds of thousands of Bitcoins. In 2019, Quadriga CX locked away around 190 million Canadian dollars worth of user assets when the founder passed away, and no one could access the wallets. And the most shocking case was the collapse of FTX in 2022, which had been considered one of the biggest and most trusted exchanges in the world. There were also other cases like Cryptopia, BitGrail, or BTCE. The common point is, when an exchange goes down, users cannot protect their funds. There is no clear insurance like with traditional banks, and no guaranteed way to get your money back. A lot of people think that big exchanges are totally safe. But in reality, the bigger the exchange, the more money is stored there, and when things go wrong, the impact is worse. No exchange is risk-free. So, if your goal is to hold crypto long-term, it is safer not to leave all your assets on an exchange. A better option is to use a personal wallet, especially a cold wallet, where you hold your own private key and have full control over your assets. That way, even if an exchange freezes or shuts down, your assets are not affected directly. Personally, I use a Ledger Nano X cold wallet from Ledger, a trusted brand in the crypto space. If you plan to hold crypto for a long time, a cold wallet is the safer option. If you are interested, I have put a link to the official site in the description to help you avoid fake products. Of course, using a personal wallet comes with big responsibility. You have to protect your keys yourself and take full responsibility if they are lost. But if you are investing long-term, trading some convenience for security is a smart move, especially for beginners. Do not put your entire investment in the hands of an exchange. Risk number 4. Human error. Losing everything because of one small mistake. In crypto, another huge risk comes from the users themselves. If you forget your password, lose your secret key, misplace your authentication device, or send coins to the wrong address, your money could be lost forever, whether it is on an exchange or a hardware wallet. Unlike banks, crypto has no support hotline. There is no one to help you recover your account. If you send to the wrong address, it is gone. If you lose your private key, you lose ownership, period. Even Satoshi, the creator of Bitcoin, would lose their coins if they lost their wallet. There is a man in the United Kingdom who accidentally threw away a hard drive containing the private key to about 8,000 Bitcoins. When Bitcoin was cheap, it did not matter. But when the price rose, that stash became worth hundreds of millions of dollars. He spent years asking to dig through the landfill to find it, offering to share the money, but he never found it. One small mistake, and that massive fortune was basically gone forever. Many beginners think these kinds of mistakes are rare, but actually, they are one of the most common reasons people lose money in crypto. No hacking, no market crash, just one careless moment, and it is all over. Crypto gives you full control of your assets. But in return, you bear full responsibility. For newcomers, this is a risk you must understand from the start, not something you learn the hard way after losing money. Risk number 5. Scams in crypto. Aside from price volatility and high-risk tools, there is another major risk in crypto that many newcomers fall into: scams. And this is a type of risk that does not come from the market itself, but from people taking advantage of it. When I first got into crypto back in 2017, the ICO model, which stands for Initial Coin Offering, was booming. At the time, all it took was an idea, a white paper, and a decent-looking website to raise a huge amount of money. Thanks to that, countless bad actors used this model to run scams. Some of these projects existed solely to raise money, and then disappear. I did make some money from ICOs, but eventually lost it all the same way. But ICOs were just one kind of scam that defined that particular era. In crypto, there are countless other ways people get scammed, such as schemes that promise fixed profits with unusually high returns, like deposit your coins here and earn daily interest. A classic example is BitConnect, which was charged by the SEC for its lending program and misleading claims to lure investors. Then there are scammers who set up fake exchanges or investment apps that look completely legit. At first, they let you deposit a small amount, help you earn some quick profits, and allow you to withdraw easily to build your trust. But their real goal is to lure you into investing a larger sum, and then they vanish with all of it. More recently, with the rise of AI, there has been a wave of scams involving so-called AI trading platforms, volatility bots, guaranteed profits, or fake daily interest dashboards. Once they attract enough people and make a big enough profit, they shut down everything and disappear. These are just a few out of thousands of different scam formats out there. The tactics, names, and models constantly change, but the goal stays the same: to take money from people who lack experience and critical thinking. Risk number 6. The entire crypto market could collapse. There is one risk that most people never want to think about, but it must be acknowledged. The entire crypto market could collapse. Take Bitcoin, for example. It is seen as the core of crypto. But in reality, Bitcoin today is mostly bought for speculation, for hopes that the price will rise or that it will become something the world truly needs in the future. It still has not been used as originally intended, a payment system to replace traditional money. Most people holding Bitcoin do not use it for spending or daily transactions. They are holding it with the belief that someone will pay more for it later. As long as that belief and hope remain, the market keeps going. But if hope fades and money flows out, Bitcoin's value could change dramatically or even be forgotten. Financial history has seen many assets rise in price, mainly due to collective belief. As long as that belief holds, prices rise. But once belief flips, everything crashes quickly. A classic example is the tulip bubble in the Netherlands, from around 1634 to 1637. Tulips were rare and luxurious, only the rich had them. But people were buying tulip bulbs not to grow, but to resell. Prices skyrocketed in just a few years. At the peak in early 1637, some rare bulbs were worth as much as a house. The entire market ran on one belief: prices would keep rising. But by February 1637, buyers no longer wanted to pay those high prices. Confidence collapsed and prices crashed. Tulips did not disappear, they were still tulips. But their speculative value was gone. They returned to being just ordinary flowers. Since then, tulip mania has been a classic example of a market built on belief, not actual use. And right now, the soaring prices of Bitcoin and many other cryptocurrencies are still based on belief, not real-world utility. So anything could happen in the future. Of course, Bitcoin is different from tulips in one big way. Its supply is limited. It cannot be created endlessly like tulips. People often say Bitcoin is capped at 21 million coins, and that is true. But if we take a broader look, the story is not that simple. Even if Bitcoin is limited, people can still create thousands or even millions of other coins that are nearly the same. And that is already happening. Just look at how many coins exist today. So if you are investing to make a profit, that is totally fine. But blind faith is never a good idea. Risk number 7. Legal and regulatory risk. There is one risk in crypto that most people rarely pay attention to, and that is legal risk. Some places allow crypto. Some restrict it. Some ban parts of it. And laws and regulations can change very quickly. Just one small change in the rules, a tighter restriction, or a different interpretation by the authorities can have massive consequences. There have been cases where people lost their assets simply because they used the wrong platform, traded the wrong type of asset, or joined a model that was later considered illegal. It is not always just about losing money in some countries. You could face heavy penalties or even prison time. This is especially risky for those who promote crypto investments to others, encourage people to jump in despite the legal risks, or treat taxes as something to ignore. All it takes is one round of government crackdowns or investigations, and suddenly, things that seemed harmless, like tax evasion, hiding money flow, or unlicensed investment promotion, can become serious legal issues. At that point, it is not just your money at stake. You could face legal responsibility, and in some cases, very severe penalties. So, getting into crypto is not just about accepting price volatility. You also have to be prepared for regulatory and legal risks, even if you think you are just investing for fun. In summary, crypto is not something bad, nor is it a scam like many people still believe. It is a financial product, and during certain periods, it can generate very solid returns for those who truly understand what they are doing. But crypto is not for the unclear or unprepared. If you get involved without understanding the risks, without knowing how the market really works, without being aware of the legal side, and without the ability to control your greed and emotions, then the chances of losing money are extremely high. On the other hand, if you are well aware of the risks, manage your capital wisely, and invest with a calm, long-term mindset, crypto is still a space worth exploring. So do not rush into crypto with the dream of getting rich overnight. Instead, approach it with the mindset of protecting your capital first, making profits later, and always accepting that risk is an unavoidable part of this game. If you are interested in learning about or investing in crypto, but are not sure which exchange to start with, I have left some links down in the video description for you to explore and choose what fits you best.